Welcome back to Insights That Matter. We spent a lot of time talking about investing, but today we're taking a different approach.
Yeah.
We're going deep into some fascinating data that might just change the way you think about wealth creation.
Absolutely.
Specifically in the Indian stock market.
That's right. We're going to uncover some surprising opportunities hidden in plain sight.
Okay.
Focusing on a unique concept called Bruised Blue Chips.
Okay, I'm intrigued. But before we get into that, why don't you quickly tell our listener a bit about yourself and your expertise?
Sure. I've spent over 2 decades analyzing market trends and investment strategies.
Okay.
With a particular focus on identifying those hidden gems that have the potential to generate significant returns.
Sounds like you're the perfect person to guide us through this deep dive. So let's get into it. Bruised blue chips.
Yeah.
What an interesting phrase. It seems counterintuitive. Blue chip companies are supposed to be those rock-solid, stable giants of the market, right?
Exactly. They're typically the companies everyone tells you to buy and hold forever.
Right.
But here's the twist. Even these giants can stumble, and that's where the opportunity lies.
So we're talking about well-established companies that have hit a rough patch.
Precisely. Our deep dive today is based on a recent study that analyzed the performance of the top companies in India.
Okay.
And one of the most striking findings was that even these market leaders can experience significant drops in value.
Oh, wow.
Sometimes 50% or more from their peak.
50% or more. That's a serious hit. Wouldn't that make them risky investments?
That's the common misconception. Remember, a bruised blue chip still possesses the fundamentals that made it a leader in the first place.
Okay.
It's like a champion athlete who's temporarily sidelined with an injury.
Okay.
They still have the talent and potential to make a comeback.
Okay, so the bruising is more like a temporary setback, not a fatal blow.
Exactly. And that's what creates the opportunity.
Okay.
Because of the price drop, you have the potential to buy into a high-quality company at a significantly discounted price.
So it's like getting a luxury car at a bargain price because it has a few scratches, right?
That's a great analogy. But before we get too excited about bargain hunting, how do we even define a blue chip company in the Indian context?
Right.
There's so many large companies listed on the exchanges.
Yeah, it seems like everyone has a different idea of what qualifies as blue chip.
You're right. The study actually addressed this by looking at a specific metric, return on equity, or ROE.
ROE.
They define blue chip companies as those consistently generating an average ROE of at least 20% for the past 10 years.
20% for 10 years.
Yeah.
That's impressive.
It is.
It shows they have a strong and consistent track record of generating profits for their shareholders.
Absolutely. This sustained profitability is a key characteristic that separates blue chips from the rest of the pack.
Okay.
These are the wealth creation machines of the market.
Interesting. Now, let's talk about why these blue chips might get bruised in the first place. What are some of the factors that can lead to such a significant decline in value?
Well, it can be a combination of internal and external factors.
Okay.
Sometimes it's events outside a company's control, like a sudden economic downturn or global pandemic that impact the entire market.
Yeah, like what happened in 2020.
Exactly.
Many companies, regardless of their size or strength, were affected by the pandemic.
Exactly. Then there are industry-specific disruptions.
Okay.
Think about the telecom sector, when a new player entered the market with aggressive pricing, shaking up the established players.
Right. Intense competition can definitely put pressure on even the strongest companies. What about internal factors?
Yeah.
What kind of missteps can lead to a blue chip getting bruised?
Sometimes it's a strategic miscalculation.
Okay.
Like an acquisition that doesn't integrate well.
Yeah.
Or an expansion into a new market that fails to gain traction.
So even these giants aren't immune to making mistakes.
No company is. And sometimes it's a lack of agility, a failure to adapt to changing market dynamics or embrace new technologies.
That makes sense.
Yeah.
Companies that cling to the old ways of doing things can quickly find themselves falling behind.
And then there's the human element.
Right.
Management changes, leadership transitions.
Yeah.
These can also impact a company's performance.
Right. The people at the helm play a crucial role in navigating the ship.
And the study actually found that this bruising happens more often than you might think.
Really?
On average, about half of all blue chip companies experience a significant price drop at least once every 5 years.
Wow, that's a surprising statistic.
It is.
So these bruises are more common than we might assume.
They are.
But the real question is, can they heal? Can these companies bounce back?
That's the million-dollar question.
Right.
And that's what we'll explore in the next part of our deep dive.
Okay.
We'll look at the signs of a turnaround, what we call healing triggers.
Okay.
And we'll analyze some real-world examples of bruised blue chips that have made remarkable comebacks.
Sounds fascinating. I'm eager to hear more. But before we move on, any quick thoughts for our listener on what we've discussed so far?
Absolutely. Don't let the term bruised scare you.
Okay.
Remember, these are fundamentally strong companies that have faced temporary challenges.
Right.
This means there could be a real opportunity to buy into quality at a discounted price.
I like that perspective. It's about seeing the potential beyond the current setbacks.
Exactly.
So for all our listeners who are intrigued by this concept of bruised blue chips, stay tuned for the next part of our deep dive.
Yeah.
We'll uncover even more insights and actionable advice.
Welcome back. Last time we were talking about those powerful profit-generating machines, blue chip companies, and how even they can get bruised, dropping significantly in value.
Right, and we were just about to dig into how we spot a blue chip that's ready for a comeback, which you called healing triggers.
Exactly. Think of it like this. You see a champion athlete sidelined with an injury. How do you know if they'll bounce back? You look for signs they're actively rehabbing, regaining strength.
So we're not just blindly buying any company that's taken a hit.
Right.
We're looking for evidence they're addressing the root causes of their decline.
Precisely. A true healing trigger signals a fundamental shift, not just a temporary blip. Let's say a company was struggling due to inefficient operations bleeding money.
That's familiar. Lots of companies try to grow too fast without getting the basics right.
And then they announce a major restructuring, consolidating business units, streamlining processes. Suddenly, their operating margins start to improve. That's a healing trigger.
Okay, so concrete actions, not just promises.
Right.
What are some other examples?
Imagine a company plagued by an uninspired leadership team losing market share. Then, boom, they bring in a new CEO with a proven track record of innovation and execution.
That change at the top can be a game changer, especially if the new leader has a clear vision and the ability to rally the troops.
Exactly. Or a company might be struggling because their core product is becoming obsolete, overtaken by technology. Then they launch a groundbreaking new product line, perfectly aligned with current market trends.
So they're not just playing catch-up, they're leaping ahead.
Right.
That's a powerful signal.
Now, here's the thing. Even when these positive signs start appearing, the market might not react immediately. Investors can be skeptical, hesitant to change their perception of a company.
It's like they're waiting for someone to officially announce this company is healed, even though the evidence is right there.
That's where your own research and conviction come in. If you've identified the healing triggers and believe in the company's potential, you might be able to buy in while others are still on the sidelines.
So it's about having the confidence to go against the grain, trusting your analysis, and potentially getting in early on a major comeback story.
Now, let's make this real with some examples from the study. One company that stands out is a major player in the auto industry. They were facing huge losses a few years ago, their stock price plummeting. Investors were losing faith.
Sounds like a classic case of a bruised blue chip.
But then they brought in a new leadership team that made some tough but necessary decisions. They exited non-performing businesses, streamlined operations, and focused on a clear growth strategy.
So they cut the fat, got back to basics, and refocused on their core strengths.
Yeah.
Sounds like a textbook turnaround.
And the results were astounding. Their stock price has since quadrupled, rewarding those investors who had the courage to buy when everyone else was selling.
That's an incredible comeback story. It shows how a well-executed turnaround can create phenomenal returns.
Now let's look at another example from the telecom industry. This company faced intense competition from a new player who disrupted the market with aggressive pricing.
The telecom sector is known for its intense competition. It's a constant battle for market share.
But this company, they focused on what they could control. They maintained a strong balance sheet, kept their team motivated, and adapted to the changing market dynamics.
So they weathered the storm by staying financially strong, keeping their employees engaged, and being flexible in the face of change.
Exactly. They didn't panic. They adjusted their strategy, and they emerged stronger. Their stock price has rebounded significantly, proving that resilience and adaptability can pay off.
These are inspiring examples, but I'm also curious about those companies that don't make it. What are some red flags that might indicate a company is simply broken, not just bruised?
That's a crucial question. Not every decline is a buying opportunity. You need to distinguish between a temporary setback and a fundamental flaw. One major red flag is poor corporate governance.
Right. That's when the leadership is ineffective or unethical.
Right.
It's like a ship with a captain who doesn't know where he's going.
Exactly. And that can be very hard to turn around.
Yeah.
Another red flag is a complete misalignment with market trends.
So a company that's clinging to the past, refusing to adapt to the changing needs and preferences of consumers.
Precisely. They might have a great product, but if it's no longer relevant, they're in trouble. Look at what happened to companies that couldn't adapt to the rise of e-commerce.
They got left behind. So it's not just about the price drop. It's about understanding the underlying story, the reasons behind the decline.
Exactly. Now, let's shift gears a bit and talk about the overall market outlook in India, because even the best company can struggle if the broader economy is weak.
Right. It's like trying to swim upstream.
Yeah.
It's much harder to make progress when the current is against you.
The study actually highlighted some interesting trends. Wealth creation in the Indian stock market over the past 5 years has been at an all-time high.
Wow, that's impressive. Considering all the global uncertainties we've seen in recent years.
It is. But there's a curious twist. Wealth destruction, meaning the amount of money lost in the market, has been almost non-existent.
That's unusual. You'd expect some losers to balance out the winners, right?
In theory, yes. But one factor that might be playing a role is the rise of systematic investment plans, or SIPs.
SIPs, where people regularly invest a fixed amount in mutual funds, regardless of market fluctuations.
Exactly. This creates a steady flow of money into the market, which can act as a buffer against major downturns.
So even when some companies are struggling, the overall market is being supported by this consistent inflow of investments.
Precisely. Now, another interesting trend is the resurgence of PSU companies in wealth creation.
PSUs. Those are the government-owned companies that many investors used to avoid.
That was the perception, but the data tells a different story. PSUs are making a comeback, contributing significantly to wealth creation.
So this could be another area for investors to explore. Perhaps there are some undervalued gems hidden among the PSUs.
It's definitely worth considering. Now, in terms of the overall market, the study suggests that the best is yet to come for Indian equities, especially over a 2-year horizon.
That's an optimistic outlook. But are there any potential risks on the horizon that investors should be aware of?
Of course, no market is without risk. Inflation is one factor to watch. If it spirals out of control, it can erode the value of investments.
Right. Inflation is like a silent thief, stealing away the purchasing power of our money.
Another factor is foreign investment flows. If foreign investors pull their money out of India, it can impact the market negatively.
So it's important to stay informed about global events and how they might affect the Indian economy.
Absolutely. Now let's bring this back to our discussion of bruised blue chips. How does the overall market outlook influence your strategy for investing in these companies?
That's a great question, because even if a company is showing signs of a turnaround, it's going to be harder for it to succeed if the broader market is weak.
Exactly. A rising tide lifts all boats, but a falling tide can drag even the strongest swimmers down.
So you're saying it's not just about finding the right company, it's about timing your investment to coincide with a favorable market environment.
Precisely. Now, are you ready to look at some specific blue chip companies that are currently showing signs of bruising? This could be the starting point for your watch list.
Absolutely. Let's dive into some real-world examples.
Welcome back. We've been exploring this fascinating world of bruised blue chips, those fundamentally strong companies that have hit a rough patch.
Yeah, and it's made me realize that even giants can stumble, but they also have the potential for incredible comebacks.
Right. But today, I want to take a different perspective, maybe even challenge the notion of focusing solely on these big players.
Okay, you've got my curiosity piqued. What are you thinking?
Well, imagine a vast, sprawling forest. We've been looking at the tallest trees, the ones that dominate the landscape.
The blue chips, those pillars of the market.
Exactly. But what about all the other trees, the ones growing in the shadows, waiting for their chance to reach for the sunlight?
You're talking about the smaller companies, the ones that often get overlooked.
Precisely. The small and mid-cap companies, they might not have the same brand recognition or the decades-long track record, but they have something else. Potential.
Potential for growth, for innovation, for disrupting the status quo.
Exactly. And because they're smaller, they're awfully more agile, able to adapt quickly to changing market dynamics. Plus, they're not always on the radar of big institutional investors, which can create opportunities for those who are willing to dig a little deeper.
So it's like being an explorer, venturing off the beaten path to discover hidden treasures.
Exactly. Now, of course, investing in smaller companies comes with its own set of risks.
Right. Their performance can be more volatile, and they might be more susceptible to economic downturns.
But for those investors who are comfortable with a bit more risk, who are looking for those multi-bagger returns, small and mid-cap companies can be a compelling addition to their portfolio.
It's about finding that balance between risk and reward and understanding your own investment appetite.
Now, shifting gears a bit, there's another intriguing approach that goes beyond individual companies: thematic investing.
Thematic investing, you mentioned this earlier. It's about identifying those long-term trends that are shaping the world, right?
Precisely. And then you invest in companies that are well-positioned to benefit from those trends. Let's say you believe that the world is moving towards sustainable energy.
Climate change is a major concern, and the need for clean energy is only going to increase.
Exactly. So you might invest in companies that are developing solar panels, wind turbines, or electric vehicle charging stations.
Or if you think the rise of artificial intelligence is going to revolutionize various industries,
You might look at companies that are developing AI-powered software robots or autonomous vehicles. Thematic investing allows you to align your investments with your beliefs about the future.
it's like betting on the big ideas, the forces that are going to shape the world in the coming decades.
Now, this approach requires a lot of research, the ability to connect the dots, and a long-term perspective.
Right, you're not looking for quick games. You're investing in the megatrends that will play out over years, even decades.
Exactly. Now, let's talk about an approach that's been around for a long time, but is always relevant: value investing.
Value investing. I've heard of this, but I'm not sure I fully understand it. Could you explain?
Of course. The core idea is that the market doesn't always price companies accurately. Sometimes due to short-term news or market sentiment, a company's stock price might drop below its intrinsic value.
Its true worth, based on its fundamentals and long-term prospects.
Exactly. Value investors seek to identify these undervalued companies, buy their stock, and wait patiently for the market to correct the mispricing.
It's like finding a hidden gem at a flea market, knowing that it's worth far more than what you're paying for it.
Now, value investing requires a certain mindset: patience, discipline, and the ability to ignore the short-term noise.
You have to be willing to go against the crowd to bet on companies that others might be overlooking.
Exactly. And you need to have confidence in your analysis, believing that the market will eventually recognize the true value of the company.
So it's a long game, but it can be incredibly rewarding if you choose wisely.
Now let's wrap up our deep dive into the world of bruised blue chips and beyond. Remember, the Indian market is brimming with potential, but it's crucial to approach it with a well-informed strategy. Whether you're drawn to the resilience of bruised blue chips, or the dynamism of small and mid-cap companies, or the promise of thematic investing, aligning your approach with your risk tolerance and financial goals is key.
It's been an incredibly insightful journey, and I'm sure our listeners will walk away with a fresh perspective on wealth creation in the Indian market.
Absolutely. And remember, investing is a journey, not a destination. Stay informed, stay curious, and never stop learning.
If you enjoyed this deep dive, please like and subscribe for more insightful content. We'll be back soon with another fascinating topic, ready to help you navigate the ever-changing world of knowledge and ideas.